And that music, it gets me fired up each and every time we do this. And it also means that we are live on YouTube. I've got Coach Matt, Coach Tim, and we've got Coach Cody in the background, kind of organizing everything and keeping everybody under control. Matt, we've got an exciting show here today, a lot that I want to talk about. But first of all, formal pleasantries. How you doing today?
I'm doing absolutely fantastic. Excited to be here with the crew.
Yeah. The thing about trading that I love is I love pretty much every day in the market, and it always creates new opportunities. There's different ways to build your edge. And today we're going to be talking about volatility and straddles. But before we get into our topic, we're going to work through the markets one step at a time. And we got a lot going on out there. Kind of a doji day here today, Matt. And really, we're holding a breakout point. You've got some stocks with strength. We'll talk about them. You have some stocks with weakness. On a day where there's not real notable economic indicators, we don't have a big jobs report or a Fed meeting or anything like that with the durable goods come in. But how do you read the chart, the price action?
Well, I mean, after three really good days coming into Thursday, Friday, and then obviously on Monday with no discernible news to really kind of drive the market, it's just kind of hanging out. And we see this quite a bit, right? After 2-3 day movement, nothing's happening in the market. Doji fest, doji fest, doji fest. And so it's going to be a lazy day in the market, in my opinion.
Yeah, this durable goods number, takes some of the edge off. And I saw the headline, I read into it. I even had to ask you, Matt, what goes into all the durable goods research? I mean, is it just industrial orders, manufacturing orders? There's a lot to it.
Manufacturing companies ordering, parts to create their products, right? It's a sign of economic growth when they are saying, okay, we're going to order all these parts to produce all these goods and all these services to sell down the road. And so when you see durable goods expand, that is a sign of economic growth. When you see durable goods decrease, that is a sign of economic contraction. And so when you saw the durable goods number come in today, and here's the core durable goods, the expectation was 0.3. It came in at 0.1. On the durable goods order, the expectation was a negative 1.1, and it came in at a negative 1.6. And if you in Forex Factory is such a good economic calendar, it's one of my favorite out there in the marketplace. If you click on the detail button here, it will tell you exactly what it measures, and then it will tell you exactly what the usual impact is. And obviously, it's typically for the currency, but the market kind of behaves very, very similar to what the currency does. And so, why do traders care about it? It's a leading indicator of production. Rising purchases orders signal that manufacturers will increase activity as they work to fill the orders. So it's another sign of economic growth or economic contraction. And when you're looking at kind of the overall data, I mean, it's a negative, but it's what we've been seeing over the course of the last 3 months when we've been seeing that slowing growth environment. And the market doesn't care about these economic reports right now, Tim. And the reason it doesn't care about these economic reports is there is a belief in the marketplace that this quarter is not going to be good. And so the economic data is not very good. But in the second quarter, the third quarter, and really coming into the third and the fourth quarter, you should see some economic expansion. I don't necessarily believe that. Okay, I don't. But that's what the market believes, and that's what the narrative in the market is right now. So the market isn't necessarily pricing in some of these negative reports we've seen. Retail sales have been really, really negative. Durable goods is negative today. We've seen negative economic reports, but the market simply does not care because it's already pricing it in. I think that the market is not pricing in the risk here 3, 4, 5, 6 months down the road, but that's the market and that's my opinion. I'm going to trade what I see, and with the market coming into perhaps a breakout, I mean, you're still a buyer here.
Yeah. There's quite a few stocks in the news here today, many that are catching my eye. I would start with Boeing and Lyft and Walmart and Google and all these other ones I want to talk about, but probably the one that's an S&P and a Dow component that's as important as any of them. And you can break down Boeing as well, but we got to talk Walgreens Boots. They're down 12% today and missed on earnings. And many people know Walgreens because they shop there, and CVS is actually on the tails of this, taking it on the chin as well. Lowered guidance, lowered profit expectations, lowered sales. They basically are having a terrible day on their earnings report, Matt. How do you interpret this space in general?
Just a miss. And we've seen this in this space, and this is not a space. If I'm a buyer, I am not looking at this space. There's no doubt about that. This was a really, really negative earnings report. And it wasn't just, the misses on EPS and whatnot. It was the guidance, Tim. the guidance, they were supposed to be growing at 7 to 12% this year. And they're now basically saying we're flatlining for the entire year. And that's why I don't necessarily agree with the market's narrative that everything's going to be rosy in the third and the fourth quarter. Because if you look at those earnings reports, and I've looked at almost every one of those earnings report in the first quarter this year, I don't see that in the numbers, to be perfectly honest with you. I think there's a lot of hope here. And it just reminds me of when I see, politicians with tax plans saying we're going to lower taxation because that's going to increase growth in the future. And the increased growth in the future is going to pay for the tax decrease in the current. And that's always painting a rosy economic picture in the future. Well, what happens if we stagnate in the future? What happens if we see a decrease in the future? Just yesterday, Tim, the S&P 500 downgraded the U.S. economy and increased the recessionary indicator up to 20 to 25% of a recession coming at us in the near future. So the S&P 500 or the Standard & Poor's 500 is basically saying, hey, listen, we're seeing an increased risk in the future. The IMF, we're seeing an increased risk in the future. The central banks, we're seeing an increased risk in the future. But the market is saying, well, we think it's going to be rosy, right? And that's just not what the economic numbers are seeing here. So I don't believe that the market is pricing in the perceived risk that if they're wrong, that we don't see the 7 to 10% growth in the third and the fourth quarter of this year. So I'll be looking forward to that. But as of right now, you trade what you see. But what you saw on Walgreens' earnings report today was just the continuation that we have seen over the course of the first quarter. Earnings per share is fine, forward guidance not. Walgreens is something you just do not want to touch here.
Whenever I see an earnings gap on a big high dollar market cap stock like a Walgreens, obviously I'm going to play off of the volatility if there's an opportunity there. But then my mind also goes to where are the other companies within the space that could be impacted by it? We looked at CVS, but I got to show you Cigna. So much of Walgreens' weakness is their weakness in sales from drug manufacturers and people going there to the pharmacy and whatnot. I mean, what do you use Walgreens mostly for? Like small goods and items and whatnot, but most people go there and spend their most money, I think, on their pharmaceuticals, right? And Cigna, as a healthcare provider as well, that entire healthcare space is under pressure recently, and it is not avoiding that weakness, Matt. There is not a lot of room. There's not a lot of support there on the downside. This is a really ugly chart.
Big old M formation right there on that chart, no doubt about that. But on the weekly chart here, you are breaking a fairly significant support level on Cigna. On the daily chart, you're pressing against short-term support on the chart here with support right around 158.50. If you break 158.50, I mean, you're a stone throw from 150. A stone throw from 150. And that's a shorting opportunity, no doubt about that. With relative weakness in this space, and we're seeing a tremendous downtrend off a weekly support break, yeah, I mean, that's a shorting opportunity on Cigna.
I'm interested in healthcare shorts. I saw President Trump came out and said they're not going to put up any kind of new legislation or vote on repealing or replacing or improving the Obamacare plan until after the 2020 election. I got news for you, President Trump. You might not win that election, so you might want to suggest something before that. If you really
he was talked to by the Republican members of Congress, and when he came out and said the Republicans last week were going to be the party of healthcare, and the Republican members of Congress like, what? We don't want to own that coming into the 2020 election. Yeah. We do not want that part. The Democrats are the ones that want that part of the 2020 election cycle. They want that in the minds of the people. The Republicans, they don't want to be anywhere near that right now. That is not a positive political stance coming into a very, very important election in 2020. So if I was an advisor to the president, I'd be like, don't talk about healthcare. Just don't talk about it.
So he's punting.
Talk about the economy. Talk about the economy. Talk about jobs, talk about manufacturing, talk about those positive things, right? Talk about those positive things. Talk about your trade deals. You've had some wins in trade. Talk about trade deals. Talk about the USMCO. Talk about the Chinese positive trade. Talk about that. Do not talk about healthcare, because that is not something that Republicans want to touch right now.
It highlights the complexity in XLV and ranking it, by the way, and we rank it every week. But XLV has healthcare plan companies in there like Cigna, United Health, but it also has biotech and it has drug manufacturers, like the ones that we've been identifying as very bullish for a long time. It's a tough one to rank because of that, and where those healthcare laws come out and how it impacts these different companies. Obviously, politics will play a role. the Trump administration is trying to punt, it sounds like. But for
It's
now,
a smart political move.
probably
That's
the right
exactly
play.
what I would do.
Yeah. Cigna and United Health and the rest of them, they're all under pressure. I'll tell you some stocks that are not, and they're actually showing a lot of strength on the S&P today. The number one that stood out to me, Matt, was Delta Airlines, DAL. And we fly a lot of Delta. We've gone all over this world on Delta planes and whatnot. We know they have a good corporate strategy and they have good clientele. They increased their expectations before earnings. They came out in front of it and said, hey, we're going to beat, guys. We're going to make a lot of money.
That's a positive news.
Yeah.
Usually companies, they'll pre-announce negativity, right?
Yeah. Yeah.
Kind of to price it in multiple different times instead of a one single 18% down on a day, right?
Yep.
So like take Apple, for example, right? Apple last quarter, a week before the announcement of earnings, what they say? Hey guys, we're going to miss. We're going to miss. And then it comes in, they miss. And then what does Apple do? Boom, 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 right?
Mm-hmm.
So when a company comes out like Delta, and I didn't even see that news today. This is the first time I am seeing that, Tim. When a company comes out like Delta and says, listen, we're going to do really good, guys. I mean, you get that pre-movement and then you have a gap. Look at this gap, breakout of 52. Look at that. And then a runaway. So I would call that a breakaway gap, and breakaway gaps typically do not fill. Now, the trigger will be complicated here because you got a lot of momentum. This is a momentum play. It's not really a standard technical movement. You got to break it down into the intraday chart to find your intraday support levels, intraday resistance levels. But typically speaking, breakaway gaps do have a tendency to run away from the gap range.
Yeah, I liked it. I liked the reaction. I like the company a lot. I've always liked the stock. You know, it kind of got stuck in the mud with oil volatility and all that kind of stuff. The airlines have been a stay away for me for a bit. Breakout earnings coming up. It might be a watch list candidate here.
Yeah, watch two things happen here. Number one, and this would be the signal. Okay, intraday, you wait for the retracement. And that is a legit trading signal, no doubt. You wait for that, and then you put a stop loss under wherever you can kind of see an intraday support level. We don't know where those are yet because we haven't seen the retracement. Or two, it high bases from an intraday perspective, and then you play the breakout of 56. That's the appropriate way to play this type of movement on Delta.
Yeah, a lot of other companies showing
very good
strength
news,
here. It's kind of a mixed market today. You got a lot of strength, a lot of weakness. Let's move on to the Dow Jones.
And I do love Delta. I hate flying anybody else besides Delta.
Who's your favorite airline out there, halftime crew? Let me know. Like,
I'm willing to bet second comes. It might be first, Southwest. It might be
very
first.
Popular brand.
And I'm going to state a very unpopular opinion. I don't get it. I don't understand it. They like literally with I can't stand flying Southwest. It drives me absolutely crazy. I feel like I feel like I'm being herded, like
cattle. Yes,
literally, I feel like I'm being herded, and it's like a fight for seats. I don't get it. Give me my Delta. Give me my Delta.
Shammy has a very good point. Korean Air, Singapore Air, some of the airlines international.
Oh, those international airlines are amazing.
Yeah, and I will tell you, and if you ever have to take a flight on Alaska, you do it in a heartbeat.
Alaska's good.
Airline as well. A lot of good airlines out there in the airline industry.
Linda, it's like, you're crazy, Matt. Southwest is great. I know. I literally, I totally understand, but it is not for me. Oh, Spirit Airlines, Marquise. Nobody enjoys Spirit Airlines.
I gotcha. All right. And by the way, welcome out. Hashtag Team Tackle, everybody. It's always good to see you. Give me a quick like and a share. We're at 57 people here. I'm sure we're going to hit 80 or 90 by the time the show ends. The earlier we get that like and share, though, it gets people's attention to come in and join us. Matt, move on to the Dow Jones Industrial, if you would. And let's keep talking markets. Stock prices are flat today, but you've got mixed action across the board. Whenever you see a doji like this on light news, Matt, we know we're not going to have, a lot of raw economic data today or tomorrow or Thursday, by the way. It's the jobs report on Friday next, earnings season in a couple of weeks. Do you cover? Do you hedge? Do you just kind of do you play golf? Do we go golfing after the halftime report? Like, how do you approach a doji day like this?
You go golfing.
I think golf sounds great, actually.
I mean, why force the action? I mean, after coming out of a good day like yesterday, good trading environment, swing trades triggering, Day trades triggering. I mean, it was a good day in the market yesterday, no doubt. But on a day like today, where there's really not a lot of action happening, not a lot of geopolitical situations happening. By the way, nobody cares about Brexit any longer. Literally nobody cares about Brexit. On a day like today, yeah, you
well,
hang
old
out.
British guys in a pub arguing over the validity of Brexit still care,
They
but the markets don't
want
care.
the exact same thing. I don't even know what they're arguing about.
They just like arguing. We
They
have
just like
many friends from the UK.
Yeah.
So yeah.
Yeah, but no, I on a day like today, you do the halftime report, you hang out with the crew, and then you go live your life.
C'est la vie. I agree, which is why efficiency and checklists matter and why we always go through the same checklist. During the halftime report, we look at the S&P, the Dow, the NASDAQ as we go through it. And then as we're talking some of these stocks though, Matt, I like highlighting some of the components because I think it's very helpful. Apple Computer is a Dow component and a NASDAQ component, and I think the chart looks great today. It's a watch list stock. It's one of my favorites and one of almost everybody's favorites. Beautiful green candle, obviously not a new trigger today, but it feels like it wants 200. I put this out there on Twitter. It just feels like it's aiming for that as a target, legitimate target, or should we take profit at resistance?
It's a bullish uptrend. I mean, the only way you take profit at 195 is if it dojis at 195 a couple days and you get a little concerned. You throw up a stop loss to say underneath an intraday support zone, and if you get stopped out, you get stopped out. But you give it a little bit of room to run into 200.
Yeah. Yeah. And we do got to bring Boeing back up here because even though it's up today, I saw another negative headline. They had another country come out and say, we're going to ground some planes. I don't think we know all the fallout yet, Matt. This is a complex pattern. And everybody knows my love of the stock. And also that I've said it's a no touch for a while. You're approaching the top of the candle that it gapped to. From a technician standpoint, that's a level of resistance now. And 400 is also right there. We're sitting at 391. So there's some room in there, but it's only 1 or 2% that you could float in here on any given day and still hit your head. Is there any opportunity on Boeing at this point for you?
No.
Yeah.
No, I if people want to jump in front of the action, that's fine. It's not for me. I don't understand it. You're trying to pick up pennies at the bottom. I mean, if you're, let me put it like this. Boeing is such a wonderful stock that you're going to have so many opportunities to trade that stock. So many opportunities. It is a wonderful stock to trade. It's a wonderful stock to invest in. You don't have to jump in front of it. I got significant issues here. I mean, the 20-day moving average just crossed the 50-day moving average. You're coming into that $400 mark, which will act as a resistance level. If you can get back up above 400, then we can start talking. But even Boeing, I can't remember what, actually it was Southwest. Southwest just stated that it's actually going to take longer than anticipated with the Boeing Supermax to come back into production. And Southwest has a lot of those planes. They're going to have to reroute a lot of it, and they're going to have to cancel a lot of those flights. So I still see risk here. I still see risk. I still see volatility. And most importantly, I still see uncertainty. And because of that, it's a stay away from me.
Yeah, I agree. I'm kind of waiting for something more clarity, maybe some time. Maybe that's all you really need here.
There's so many variables in trading, Tim. Why do we have to trade a company that has increased variables on it right now?
You don't.
I mean, if pick your poison, Cisco, Apple, or Southwest right now. And
Cisco,
not Southwest. I got Southwest on my head.
Yeah.
Apple, Cisco, or Boeing.
Oh, Apple and Cisco, easy. I mean, Cisco's already in an uptrend up at a high point. Apple's been bullish. I mean, clarity in the charts and in the strength of the index that I have ranked number one. I mean, it's top-down analysis, Matt.
Yeah.
And move on to the NQ and let's keep talking about that because even though I've loved the Dow in the past, I had it up at the top at different points in the last 3 months. The NASDAQ has been a juggernaut. And your Cisco's, your Apples, Amazon is approaching a breakout point. We're seeing a lot of strength in tech, and those are the companies that are grabbing my eye for the bullish side. Not completely, but a lot of them are. We're now approaching a resistance here, Matt. When you're already up 5 candles in a row, hitting resistance, I mean, it is what it is. Do you take profit? Do you let your trade play out? Give the team some direction on that.
You let your trading plan play out. I mean, it depends on what you're trading. If you're, I mean, if you're trading the NASDAQ itself, yeah, maybe you do lock in some profit. If you're trading components within the NASDAQ and they're not at targets, I mean, it's a different beast. I'm not going to lock in profit in a bullish uptrend simply because the market is hitting a resistance point. I mean, because in a bullish uptrend, what does resistance do? Resistance fails. That's what creates a bullish uptrend, is when resistance fails. And so I'm not going to lock in profit simply because resistance is hit, simply because resistance is hit, or simply because resistance is hit. Resistance fails in bullish uptrends. So maybe you trail stop losses. Maybe you stop adding bullish trades until we see a breakout. But I'm not going to lock in profits simply because the NASDAQ's hitting a resistance level, or any index for that matter.
You know,
especially, I mean, take the S&P 500 for example. The S&P broke out yesterday. It's dojiing today, but it did break out yesterday, and most likely destination for the S&P is 2,900 at this point. I mean, that's not a guarantee. Nothing in trading is. But with the S&P breaking out and the Dow kind of sitting at resistance, and the NASDAQ slightly underneath its resistance channel, no, I'm not looking to be too cautious here. Maybe not bad, but I'm not looking to just lock in everything.
I agree. And there are individual opportunities that you have to make decisions on based on your overall market read, though. And so the uptrend is intact right now. You're above moving averages. You're approaching resistance. Does that give you a secondary bit of caution? Sure. I mean, that's natural and logical, but it shouldn't change your overall game plan and your portfolio design. I'll tell you, out of all the tech stocks that are on the big side of it, the mega companies that are grabbing my eye today, Facebook is number one. Facebook, it was the greenest spot on the heat map from the big names. And there was just some positive 3% move here today. They say they're going to announce some news feed over on their Facebook to try to get legitimate news back on Facebook, Matt. Whatever. I was highly critical of them the other day. I already know the answer to this.
Ask the question. I mean, no, I don't care.
Will you change your opinion about Facebook if they legitimize their news feed?
Okay, Facebook and legitimate news do not go hand in hand. That's like oil and water. Okay, so no, I don't trust. Okay, wait. Here's Facebook. I know we have stolen your private data and shared it with third parties for years and years and years. I know we have profited billions of dollars on sharing fake news with everybody in the market. I know that, but now trust us now, because we're going to make legitimate news. And it's like, Facebook, you're a joke. No, no, of course not.
I'll tell you an interesting story I read is Walmart is partnering with Google.
I will buy that breakout on Facebook, though.
It's a breakout candidate. There's no question. I was very cautious and neutral. I'm concerned about the pattern, but
Straddle would have been good.
Yes, it would have. Yes, it would have, which is our topic of the day. But I want to bring up another one of these big tech companies right now, Matt, because I found it interesting. First chart on Walmart and then Google. Walmart's not moving on the news, but I really liked this story that I was reading into, and I don't know exactly when they're going to release it and whatnot. They're talking about exploring a partnership between Google Payments and Walmart. They want to work together to get the online stuff working a little bit better. I'm still a huge believer in what Walmart is doing right now, and I love the chart on Google. It's been very, very strong for a while. Walmart's stuck in the mud with a lot of the brick and mortar retailers. I know that, but
if Google breaks 1206, I'm going to eat some crow on Friday.
You might. Yeah. It looks like it wants to do that. Any market strength will probably confirm that. We have to wait and see. There's a reason why they call it trigger confirmation. It hasn't happened yet.
Well, I mean, it depends on whether you categorize that a retracement on last Friday or not.
Yeah.
Many of the traders did. Right. There was only me and maybe one other that did not categorize it as a retracement. And so if you categorize that as a retracement last Friday, you have confirmation already. You absolutely do. If you did not categorize that confirmation, you're probably not even trading it above 1206, which means I'm not even trading it above 1206.
Yeah. Yeah, it's a tricky pattern if you micro focus on those pivots, which technicians do, by the way. That's the definition of technical analysis. You have to identify where your levels are.
You do. And there is some subjective bias you know, when you're analyzing a chart, you put two technicians in a room, one's going to call it a retracement, the other one's going to call it something else. And you know, who's right, who's wrong, only the future will tell. But I don't regret vetoing Google from the report. I'll be perfectly blatantly honest with you. I still think it's a complicated pattern to trade, and my concern was for our team being able to trade a complicated pattern.
I got no problem with it. I'll tell you what's not a complicated pattern to trade is a breakout on Amazon here. If you see confirmation from this point.
Nope.
Now we're sitting into some resistance.
Yeah. Hey, Tim, I got a question for you.
Yeah.
Yeah. Jimbo, the pin collector. I love Jim.
Yeah.
Jim says two things. Matt hates Facebook. Yes, I do, Jim. And he says, wait, is Fang back? Right?
100%.
Is Fang back, T?
Yes, 100%. Okay. There's only so many places you can put your money, and the market has been bullish. You also had this rally that came off of that one-day recession that has ramped 15% through the quarter. Okay.
Yeah.
So now I think institution investors, if you got to ask yourself, where am I going to put my cash? And you've got a market that you feel is stabilizing, if that's your belief. Now, we talked about this yesterday. I have real concerns about Q4, Q1 next year, you know, potentially if this earnings growth storyline doesn't play itself out. And I do think we're still going to see pain at some point. But let's assume you see the world as roses and you believe that the market's just going to run and be bullish through the summer and the spring and all of that storyline. Where are you going to put your money? Large cap tech is one of the first answers you're going to give. Okay. And that's because of just the nature of seasonality. And these companies had taken it on the chin, Matt. Amazon, Microsoft, you know, Apple, Google, Netflix, Facebook, they're all attractive and they've all been performing very, very well for about 3 months now.
If you're going down the checklist on Fang, Facebook, underperforming a little bit of the market, but certainly a tradable candidate right now. Certainly, right? You look at Apple. You know, Apple, technically Apple's looking really, really good right now. Mm-hmm. You look at Amazon. Anybody who trades Amazon will buy that breakout. We'll call it 1825. Okay. Mm-hmm. Really good. Then you got Amazon. Okay. Then you got Netflix. Netflix, a little bit of consolidation here. I would still call it a bullish uptrend. Little bit of slowing momentum here. Google. Whether or not you trade that, you got to love the bullish uptrend, right? Whether you categorize this a retracement or not, you have to love this bullish uptrend. So is Fang back? I would not say it's back in the same degree that when Jim Cramer came out 5 years ago and called Fang, right? Mm-hmm. I wouldn't say that. I wouldn't say that Fang is back in the sense that it is going to be the number one driver of the market for 3 to 4 consecutive years, where all of these stocks just completely outperform everything else. And these stocks go up 20, 30% a year, and the rest of the market averages 5%, and the market totally averages out at 12, 13, 14% a year. So I wouldn't say it's back in that capacity, but is it back to the point where these stocks are going to be drivers? Yes. Yes, it is. Okay. Not just, my argument is just not to the exact same degree that it was from 2013, 14, 15, 16, and 17, right? Yeah. I think it's back in the short term, but not back to that same degree.
Mm-hmm. I agree. You know, it's really interesting when you think about it, because when you're doing top-down analysis, you're working through all the different components. Major companies of this size, they affect your top-down analysis. They're not just individual companies on your watch list. I mean, what Apple, Amazon, Netflix, Google do, it matters to the way you approach the market, whether you trade them or not. There's no debate.
All you have to do is look at the heat map, Jim. That's all you have to do. Look at the size of Google, Facebook, Apple, Amazon, Microsoft. Yes, these large cap, these mega cap companies, they are the most important companies to the market. And that's always the case. I remember when ExxonMobil, which is still a massive, massive company, sure, right? But I've been trading long enough to remember when ExxonMobil was the number one market cap company in the world. And every day people would look at ExxonMobil as a market driver, right? Every single day they would be talking about Exxon the same way they would talk about, Apple and Google and Facebook and Amazon over the course of the last 10 years, right? So every market's going to be top heavy when the bullish markets happen, no doubt about that. But that does change. It does. But for right now, yeah, I would say these large cap companies, they're back in the short term.
And it's kind of, while we're still talking stocks, and I got to bring the stock up, Wells Fargo, bring it up, WFC, if you will. Not a tech stock, but definitely one in the news, Matt. They had their CEO come out and say that he's leaving last Friday and the stock was dropping. It's now holding on to this level right here. But the market ran on Friday and Wells Fargo didn't. The market ran on Monday and Wells Fargo didn't. Now you've got a red candle down 1%, about to break down on high volume the last 3 days. It grabbed my interest. I know we've got earnings coming up. It's probably going to be a stay away. But the financials, Goldman Sachs, JP Morgan, Wells Fargo, they are not showing me a lot of strength. So is FANG back? I'm seeing institutions put money into areas like tech and rotate out of healthcare and finance.
I love Jim's FANG. Instead of FANG now, or FAAANG. We got a Ramco. Got to put a Ramco.
And then add an M on the back end, Fangum style.
That will be the biggest IPO in the history of markets.
It's exciting.
Yeah.
It's all exciting. Stocks are flat and mixed today. You got some strong, some weak. Give me the RTY. Let's keep moving through it. And we're talking straddles today, by the way.
T, real quick on Wells Fargo. You're absolutely right. It's not tradable any longer. You're too close in front of earnings. But that is something you should absolutely collar if you're an investor.
If you're an investor and own it, that's a collar situation. There's no question. Yeah. Good call on that. RTY, real quick, just take a peek at the small caps. There's not much going on across most of the indexes. Relative weakness, Doji today. Anything to see here, Matt?
Look at that. It's almost like technical analysis works.
Ding, ding,
Kiss
ding.
It. Boom. Yeah, nothing to see there.
Yeah, I don't see it either. Moving on to the dollar. Theresa May fails again. And I don't know if she's failing. Care. And nobody cares.
Whoa. Did you say you don't know if she's selling? She's failing. What are we doing here? She's failing, bro.
Is there anything in the currency markets right now that's grabbing your attention?
No, not this week. Outside day trading.
And then the unemployment rate on Friday could do something, but until then, probably not, right?
Even at that, though, T. And again, it's not that it's not legit. It's just not my style. Even if a positive unemployment report breaks out at 97.70, I'm still not swing trading that because everybody knows me. I don't like, sprints in a marathon. And you have a marathon here, you sprint, come up to 98, retrace. So to me, even if it does break out, unless we consolidate before the breakout, that's a different story. But if we just break out without consolidating, I'll wait for the retracement on that.
I'll tell you one thing that is continuing to run here today is crude oil. Crude oil has been strong. We called the breakout. We called the bullishness. We've called it for a while now. It's maintained the trend. It's now blasting out again. More headlines. I mean, these are the common headlines you see. Oil prices jump on OPEC cuts, right? And Shell sees rise in Nigeria oil spills in 2018. And you look into the fundamentals, you're like, it's the same basic fundamentals we've been seeing for a long time. I don't see material change there, but what I do see is a chart that has recovered a great deal of that massive correction. Now, Matt, you have old major support in June of last year and August of last year that it's going to be coming up into. Is it destined just to test those levels?
I still maintain the $2 to $2.50 range on the breakout, Jim. That's kind of what I'm seeing in this pattern. And obviously, these levels are going to play a role, right? They're going to play a role in what's happening in crude oil. And if we can get back above those levels, yeah, I mean, that's a pretty good little sign. You just broke out of this old level of support right here at 62. You're currently at 62.34. But again, I come back to these breakouts here. When this breaks out, Tim, it breaks out 250. Where does it run? 55. That's a $2.50 range. Breaks out of 50. We'll call it 57.5. Runs up to 60. $2.50 range. It breaks out of 60. Runs up to 62.23. That's a $2.34 range. So you're, in my opinion, you are at the top end of its probable movement, right? That does not mean it can't run. That's not what I'm saying. it can certainly run, but you are at the top end of its breakout pattern here. So for me, if you did trade that breakout, I wouldn't just get out of the trade just because historically it does run 2.5 to 2.5 after the breakout, but I would be trolling up stop losses.
Yeah. Yeah. And it's going to be a 2-day record here. 2 days in a row. We're going to talk Bitcoin. Matt, bring Bitcoin up. By the way, we might be talking about a lot more. Okay.
We could.
Now, here's the thing about Bitcoin. It just went up 17% and kissed 5,000 after we talked about technical analysis and a breakout. And Matt said that we have a breakout developing. And even though he hates it, I think we've got to all give Matt credit. Everybody say, great call, Matt. Bitcoin ran today. It might be the story of the day. And I have no idea why it's up 17%, Matt. I track Bitcoin. I looked into the news. My instinct is institutional.
It's because Matt said it's going up. It's the justice effect. It's because Matt said it's going to break, and everybody's like, "We got to buy this thing."
Yeah.
So listen. A deadlock is right twice a day, but it's almost like technicals work. That's all it is. Technicals work. It breaks out of a consolidated range. People are going to see that, and the news was some big investor, some big trader came in with multiple different 7,000 Bitcoin lot size orders on different exchanges. That was kind of the news on the breakout, but that's not random. Somebody was waiting for the breakout and they had an existing order to buy the breakout, in my opinion. Okay. And it obviously moved the momentum. Now, I will tell you, for me, this piques my interest. It does. You have a reversal in trend. You have an increasing support level. You have a horizontal resistance level with an increasing support level on a breakout. If that was anything else we were analyzing, take Bitcoin out of the equation. If that was any stock, any commodity, anything, you would call that a breakout and you would say, quote, put this on a watch list, wait for the retracement. So to me, don't chase this, but this is now something that is in the trader's conscience, and traders are going to now start looking at it. And when I say traders, I mean hedge funds, institutional traders. They're going to start looking at this now. And so it's going to be volatile on this break, no doubt about it. Let the volatility subside, but I do think it's back into that. Hey, it's time to really kind of start watching it.
And two last things before our topic here today. And by the way, we're going to have fun with the straddles, but give me a quick look at Lyft, and then give me that screener I showed you earlier that I just thought was fascinating. You know, guys, we've been talking, and I know it's a green little candle today, down about 1%. From the IPO price, Lyft has gone from 82 to the high point on that first opening day, now down to, what is that price, Matt? 68?
66.
It's
currently 68, low of 66.
People keep getting trapped into these IPOs on releases. And, I've gone back and I ran a screener at FinViz, and I went back and looked at stocks that have IPO'd in the last year. And Matt, just kind of talk about these patterns and really give me a little soapbox here for a few minutes.
This is why we say stay away from IPOs. And Tim, we yesterday we recorded the podcast, and one of the questions in the coach's mailbag session was, I can't remember how the question went. Anyways, IPOs. Okay, this is why we stay away from IPOs. Initially, and this is back in the day, 1980s, 1990s, and even into the 2000s, IPOs were hot. They were hot. They would come out. You wanted to get in. You wanted to be a part of that. IPOs now are not that way. Very rarely do we see an IPO just, come out. It just shows a great bullish uptrend from the very beginning. What do you see in almost every one of these charts, Tim? In almost every one of these charts, you see bearish downtrends. In almost every single one of them. OZX comes out at $50, currently at 30. You just see this tremendous downtrend initially, and it's not on every one of them, but you see volatility, you see a downtrend, and then, like I said yesterday on Lyft, at some point the hate does go too far, right? At some point, when all those consumers who bought the IPO, which is ridiculous behavior, But the consumers who buy those IPOs, who aren't educated investors and traders, they know the company, they work for the company, they're familiar with the company, they work, they either use Lyft or they drive for Lyft, and they come out, I know Lyft, let me buy Lyft, it's a great investment. And it's like, no, it's not. Let it settle down. And so you take a couple examples here. I'll just give you one example that caught my eye. CVIA here, and I have no clue what this company is. I have no clue what this company is. But when you look at this, comes out, dings at 28 on the IPO. Initially just down, 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 down. Small green candle. People are like, hey, now it's time to buy. That's what you're seeing on Lyft. Down, 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 down. Finally, the consumer's like, I just lost all my money. Let me capitulate. And then look what happens. Reversal patterns happen, a positive earnings report happens, and you get a retracement with an upward movement in price. That's a really good technical signal on this company right now, on CVIA. So in terms of that, wait for the better setup. Don't go against this data. This data is overwhelming, Tim. This data is absolutely overwhelming. And I have not taken account, but I would say 80% of these stocks initially went down.
Well, even look at that stone. I mean, that's one I've got on my watch list right now. We talked about it in the halftime report the other day.
Yeah, STNE.
And it's grabbed my eye. It's obviously a growing company right now, but when it IPO'd, it dropped for 3 months in a row.
It dropped 60%, Tim.
And that's the best example out of the entire list. Okay.
Yeah.
I mean,
look at this one here. CVET comes out, IPO, boom, 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 boom. I mean, so for every AZRT that actually goes up on the IPO, you have a plethora of other data. Tilray was a unique example, obviously. But you just have all this data that you're fighting against with IPOs. And to me, it's take EPRT. Neutral, breaks out of neutral, look at the price appreciation.
Runs. Yeah.
Neutral, look at the price appreciation. Neutral breaks out, price appreciation goes on a run. And so I really see this as the Facebook effect. I really do. I remember when Facebook came out, IPO, and I believe it was 2012. I have never in my life gotten so many questions, emails, text messages, Facebook messages, you name it, then when Facebook came out as IPO. And everybody's like, are you buying? 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 And I'm like, no, I'm not buying. At some point, the hate will go too far, and then that is a wonderful buying opportunity. So when it comes to Lyft here, oh my God, Jim Cramer promoting Lyft on CNBC the other day. Lord Almighty, he should be paid by Lyft as a marketer. That's what he should do. And he should apologize for everybody that had bought that IPO off him heavily promoting this IPO. That is absolutely ridiculous. It is so sad that people will watch that nonsense, go out there and make trades and investments on that nonsense when I know he owns the stock and he's just pumping it. And so in terms of this, wait, be patient. Patience is a position. Be patient. Wait for the trend to develop, wait for a double bottom, wait for something that has a high probability type scenario. And maybe we get that in the next month on Lyft. Maybe we see a trend and a double bottom at $68 or $50. Wherever that happens, it doesn't matter. I don't care what the price is. I want to see the price action show me a consistent trend and a consistent pattern.
100%. And, just another public service announcement. Make sure you do your research before you just jump in. So many of the casual investors out there, Matt, they hear about a brand that they like, and they're going to come out public like Facebook or Lyft or even when Uber does it or whatever. I mean, I like Slack. We use Slack. I'm not going
to. I offend somebody every day, Jim. Yeah. Literally every single day, somebody who's watching the halftime report or the podcast. And, I don't hold back on my opinions. Everybody knows I'm a very direct person. Okay. I hope you guys understand why I'm a very direct person. I don't have time to beat around the bush on this. So I'm a very direct, and so I say things about stocks all the time, good and bad. And people are like, oh, I just so offended that you said something bad about Apple or Lyft or Google, whatever it is. Guys, these companies don't know you exist. They do not know you exist. You are literally a number on a data sheet to them. We should not fall in love with companies. We trade companies. We utilize companies for the exact same reason they use us, to make money. Period. In a sentence. Leave your bias at the door.
Market doesn't care about your feelings.
No, it does not.
No, it does not. No, it does not. It doesn't mean you can't do your own consumer research to apply to why you would like a company like Yeti. Okay. I love Yeti, but I'm going to wait for technical signals on Yeti. I love Spotify, but I'm going to wait for technical signals on Spotify.
Yeah.
It's okay to like companies, but you don't let it bleed into your decision making.
I
Matt,
love Tim. I love companies.
Yeah.
And I don't like some companies, right? I don't invest in the companies I don't like. I'm too biased. I don't trade Goldman Sachs a lot. I don't, because I'm biased towards that. So I understand my own limitations, and I don't put myself in a position to where I will have an opinion on something when I'm trading.
I agree. Now, here's what we're going to do. Last 15 minutes here, actually 11 minutes, and we're going to go a little bit long, maybe a couple minutes if we had to. But I want to talk about straddles. In the chat, everybody type in the word straddle, okay? Straddle is a bi-directional volatility strategy. And it's not the only one. There are many of them that I love. I love debit condors and inverted butterflies and strangles, but those are for other shows. Today, we're talking straddles. And we're talking straddles specifically as an earnings expectation play, Matt. There's a thing we call the volatility cycle. And we went out and found a couple of companies that we thought would fit as good candidates for examples. Let's talk about those. We have AEO, ANF. I've got a couple other ones. I like Cigna as well. Bring up AEO first, if you would, and bring up the chart.
Yeah.
Straddle is a bipolar strategy. That's actually correct, Jimbo.
It really is.
So here's an example, and we'll pick one, and we'll actually build the risk graph out. And we can pick any of the ones that we identified earlier. When you do a straddle, Matt, you want to see a company that has earnings like 4 to 6 to 8 weeks out. If earnings are next week, you're not going to straddle that company for a volatility play. Now, there might be other plays, there might be other ways to do it. Number one is you have to have a time rule. You then have to have a volatility expectation. And the basic premise, the basic idea is that the implied volatility needs to be low and that it will build up over time as investors and traders anticipate the earnings event. Talk about AEO's volatility cycle here, if you would.
Well, everything about straddles is understanding implied volatility, right? Understanding the implied volatility of the stock. And there's a certain cycle with volatility when it comes to earnings specifically. And a lot of this is basically investors buying put options to protect their investment. And as we get closer to the risk the risk off environment of earnings, people will buy insurance to protect against that investment. And that's the reason why implied volatility typically goes up in front of the announcement, is the market makers are pricing in the risk of the actual earnings announcement, and people are buying put options. And as we get closer to the earnings, the value of those put options have to go up to cover the risk, right? So if I'm buying put options today and we have 7 weeks from now an earnings report, the volatility is not going to be that high in the stock because the risk that we're talking about isn't until 7 weeks from now. But a week before the earnings announcement, we don't have a lot of time. So you're going to have to pay a higher premium to protect against that investment from an insurance perspective by buying put options. So what you see here on the chart is you see a implied volatility, and that's what this blue line represents. You see implied volatility and kind of the value of the options. Now, as volatility goes, as represented by Vega in the Black-Scholes model, delta, theta, vega, gamma, and rho, Vega represents volatility. As volatility rises, the value of options go up. As volatility falls, the value of options go down. So when you're doing a straddle, it's a bidirectional trade is what it is. So we're expecting basically either an upward movement or a downward movement, but it's really about that volatility rising. If you don't get a volatility rise, you need that stock to move a tremendous amount to offset the risk to theta, which we'll talk about here in just 1 second. So when you're looking at the straddle, you're really focusing on 3 things. And I want everybody to write these down in your notes. Number 1 is delta. Number 2 is theta. And number 3 is vega. And you have to look at all 3 of those components when you're looking at trading a straddle. And Nicholas, the difference between a short strangle and a long strangle is, 1, you're buying the volatility increase, and that's the long strangle. And number 2, you're selling the volatility at the top. And so when volatility gets high in front of the earnings, we will actually sell options in short strangles or inverted butterflies to take advantage of the cash flow. Basically, it's just the exact opposite of the long strangle. So when you're talking about the strangle, we're talking about a couple things. Number one, it's all about earnings and the volatility rising in front of earnings. Number two, you're looking at somewhere around 4 to 7 weeks out from earnings, just depending on where you're looking at the volatility and whatnot. So we want to play this about 4 to 6, 7 weeks in front of the earnings so that we can take advantage of that volatility rise coming into the actual earnings announcement. Now, a straddle is simply this. When you come to the option chain on a straddle is simply you're buying a call option and buying a put option on the exact same stock, anticipating that volatility increase. What you're trying to do with the straddle is take out the directional risk. So like for example, Tim, if I bought a call option on AEO, right, and volatility rises, that's going to help my position, correct?
Correct.
But only if the stock does what?
Goes up.
Goes up, okay?
Yeah.
And if I buy a put option and the volatility rises, that's going to help my position, but only if the stock does what?
Well, the stock needs to go directional to make a straight play work.
Exactly.
Got to go down. Yep.
So if I buy a call option here, okay, if I buy a call option there, I make money as the stock goes up. If I buy a put option on the same stock, and we'll just do the same delta here. If I buy a put option, I make money if the stock goes down. If I buy them both, it creates a volatility trade where you can see this V-shaped risk graph right here.
Give me a quick peek at that option chain. Sorry to interrupt. I just want to make sure we're at the right midpoint offers. So 165, 175, 215, 230. So it'll affect the break evens. So bring that down a nickel or a dime.
Oh yeah, I'll do that. I'll do that here in a second.
I love you, brother.
I was just showing kind of the difference between the call versus the put. Okay, so basically what we're doing on the straddle to mitigate the delta risk, we're buying a call and the put because we don't care if the stock goes up or down here. This is not a directional trade. This is a volatility trade. We want to mitigate theta. We want to mitigate delta and make this solely about volatility, solely about that blue line going up. And I've said this many times in my life. There are some very complicated things in trading, extremely complicated things in trading. Directional trading is one of the most complicated things to learn as a new trader. But suggesting that blue line going up in front of earnings when historically the blue line goes up in front of earnings is not one of those complicated things, right? It's not one of those complicated things.
Yeah.
So the only thing I'm saying is the blue line is going to go up in front of earnings.
Time is most predictable. I would say volatility is second.
Yeah, right? I agree.
Yeah,
100%.
Out of Delta, Theta, Vega you just listed, I would say Delta's least predictable because you have to be right on direction, but also is most profitable if you're good at Delta. Well, Theta is the most consistent, and then Vega.
Yeah, okay. So probability versus probable return, right? Delta has the highest probable return, but lowest probability of success. Theta has the highest probability of return, but the lowest probability of return. Vega has the second highest probability of success and the second highest probability of return. So it's just every time you get higher probability, you get less return. That's just kind of how it works and everything. So in terms of this, what we're going to do is we're going to come to the Analyze tab, and here's the rules, okay? Larry, write this down. Here's the rules. We want to buy enough time that theta does not really impact the trade that much. So even though we're only going to hold 4 to 5 weeks in this trade in front of the earnings, we typically buy 3 to 4 months of time. So everybody write down in the chat. And whenever you're dealing with option strategies, guys, it's always time and price. I mean, time is the expiration date. Price is your strike price. So everybody write this down. We buy 3 to 4 months of time. Everybody write that down into chat. Lock it in. And guys, the reason we have you write things down is people just remember it more when you write something down versus when you just hear something, right? So taking action will help you understand it. So we buy 3 to 4 months of time. So on AEO here, I only have 2 real things. I got a 45-day contract. I got a 136-day contract. I'm going to go out to the 136-day contract. Now, the second rule you have is your price rule, right? And your price rule on a straddle is you're typically at the money, right? You're typically at the money on a straddle. And so, like, for example, a straddle is simply you're buying the same strike price on the same expiration date, but you're buying a call and you're buying a put. Now, there's a couple ways to do this, though. Number one, you can say, okay, I'm going to match my delta. That's number one. Number two, I'm going to match my price. Okay. So as you can see here, I got a 165 by 175. I got a 165 by 175. So you could buy the 22 call and buy the 21 put because they match in the price. Or you could say, I'm going to buy the same delta. 50 versus 49 would be the same delta. Tim, what's your recommendation there? Do you match price or do you match delta?
Well, when you're at $1 strikes, it's less of a concern for me one way or the other. I don't think you're going to make a huge mistake, but you can get into some situations where this is more important, like on $5 strikes or $10 strikes up at the higher prices. I'm going to match prices more often. I'm going to lean on that over delta, but then I'm going to risk
close,
it.
though.
I mean, here's the basic idea. I want to have my starting point of my risk graph be truly bidirectional. I don't want to have a bias one way or the other.
Well, and if you spend, 225 on the put and you spend 170 on the call, you're spending about 20% more money on the put side than you are on the call side. That's not offsetting. I'm fine either way, to be perfectly honest with you.
Yeah, the 22 puts 50 cents into money. The 21 call would be 50 cents into money. I know it's a different delta. If you're out there and you're new and you want simple, just match the deltas. There's a reason why we use delta rules.
Match the deltas.
Once you've done a lot of these, you can add complexity is the advice I'd give.
New traders, match the deltas. That is the absolute easiest way to do it. Matching the deltas. Okay. Yeah. So we're going to match the deltas at 50 and 49. So I'm going to buy the $22 put option. I'm going to buy the $22 call option. Now that creates a debit of $3.93. Okay. So I'm going to spend $3.93 per contract. Now, if you look at the risk profile here, we make money if it goes up and we make money if it goes down, right? But again, it's delta, theta, and vega. So the first thing I'm going to show you guys is how theta impacts the value of the trade. Now, I'm just going to randomly put some numbers on where this stock could go directionally over the course of the next 5-6 weeks. So this stock can certainly go down into the $19 range, or it could certainly go up into the $24 range. So I'm just going to put my price slices at 24. And I'm going to put my price slices at 19. Okay. Now, the first thing I'm going to show you guys is how theta impacts the value of those calls and those puts. So as you can see, we're sitting right here on 4.2. If I go out, and when's AEO's actual date here? It's 5:30. So I'm going to come into this. I'm going to say, okay, we're going to hold, I'm not holding this through earnings. We're going to hold somewhere around the week before earnings, because the week before earnings, it kind of volatility a lot of times flat lines, if not comes down
one more month.
Okay.
One more month. You've got April. We need May. On that month, you just clicked.
Oh, gotcha.
Yep.
Okay. Yep. Okay, here we go.
Beautiful.
There we go. Okay. Now, as you can see, what happened, guys, when I changed the dates is you saw what happens to the value of my calls and my puts if they go down. As you can see, we lose money. And if it stays identical, we're going to lose $80 on theta of the $393 we're buying or we're trading. So if the stock stays neutral, we're going to lose money. Now, what's going to happen to volatility over that time frame, Tim?
It's going to go up.
Volatility is going to go from where it is at 34, and we're just going to project that it goes into 54.
Yeah.
We're just going to project that it goes into the same levels that historically it does before earnings. Okay, now this one actually went higher than that, but typically it goes into the 54, 55 range, which is 14 points on volatility. So if we click on this little wheelhouse here, see the volatility adjustment, I'm going to say it's going to go up 15 points. Now, as you can see, what happened to that blue line, that pink line? Well, we saw an increase to offset the theta risk, right? And then if we get any directional movement on top of that, we actually make money, which means at the end of the day, what you're really seeing here on the straddle is the increase in volatility is going to offset the theta risk. And typically that's about break even at the money.
Mm-hmm.
And then what happens is you create a directional trade to where if you get any degree of movement up or down, if you get the volatility increase, right? And that's an if. You don't always get it, right? It's not a guarantee, and you're probably not going to capture all of the 15-point movement on the volatility. But if basically you're mitigating volatility versus theta, making this a directional trade off delta.
I love it. And listen, I mean, we even just going through this morning with you and doing some scanning, we were in there pre-market and before the show, and we found probably 10 or 12 candidates. There's so many different ones that have volatility cycles that are very consistent. Now, the standard indicator on Thinkorswim is called implied volatility. And we also have a custom indicator we do called IB rank, where it actually color codes green and red based on volatility cycles. You can see with AEO here right now, it's down in the green, Matt. What that means is that volatility is really low relative to its historical cycles. Mm-hmm. And we can click through a bunch of companies like we had Abercrombie and Fitch as well.
Lulu was another one. Viacom.
Pan W. Palo Alto, Pan W is maybe the most clean.
Love this because I have calls right now on Pan W.
Yeah.
And they are driving me crazy.
Yep.
I mean, they're driving me crazy. Okay. I'm about break even on the call right now, Tim. Okay. I think I'm slightly up a little bit, but I'm about break even on the call right now. And we have an earnings coming up here in about 7 weeks from now. Class, halftime crew, team tackle. What's going to happen to volatility on Pan W coming into the next 5-6 weeks? What do you guys think? Mm-hmm. What's going to happen to the IV rank? Is it going to go up? What's going to happen? Stay the same? Go down? I agree with Tanner. Okay, it's going to go up. Yeah. So the first thing is we were talking about straddles, Tim, and I was kind of complaining about Pan W not giving me that breakout at 250. Well, what else can I do?
You could just straddle it.
I could straddle it, right?
Yeah.
And so what I'm going to do is I'm just going to straddle Pan W. Is what I'm going to do. And I got enough time on the call options that I'm going to just buy the same put option on the opposite side of the equation, and I'm going to straddle it to take the directional risk out of the equation.
I love it. I love it. And you can even see the value of having like a color-coded volatility ranking indicator. And by the way, guys, this IV rank is something you have to custom code in. Would you guys have an interest in getting the code on this? Is that something you would like? Because then it will show you when it's green, it's undervalued on volatility. And when it goes in the red, it's overvalued on volatility. Matt, I know we've got blogs on this stuff, but I think the code can be hard to find. What's the best way for somebody to get that?
Guys, if you want the code for our pro members, if you want the code, just email team@tackletrading and we'll send you instructions on how to do the code and how to put it into your Thinkorswim. It's a little complicated the first time you do it, but if you're a pro member, go ahead and email team@tackletrading. And if you're not a pro member, what are you doing? Go over there and become a pro member and we'll email it to you.
Yeah, just send us an email, team@tackletrading. I'll make sure that Mark knows how to build all that.
And not just the code, Tim, but let's put instructions in the response email that we send on exactly step 1, you do this, step 2, you do this, step 3, you add it. It's a really good custom indicator that it basically it's the exact same thing as implied volatility, as you can see here.
It just color codes it.
It's just we like color coding. That's what we like. So email team@tackletrading if you're a pro member. If you're not, sign up for a pro member. We'll get it over to you.
100%. And as you look at these different charts, volatility cycles are incredible, Matt. And let me have the screen here for just a minute, just 2 seconds. Then we're going to close the show. I know we're long. It's not going to take long. By the way, everybody out there, great for being here. I love volatility trading. I love all the different stuff. Let me know if you can see that, Matt.
I can see you.
Pan W. You had me for a minute. Now you can probably see it coming up. If you can see that same chart on Pan W, give me a yes in the chat.
Yep.
The further you go back, you can start to see the consistency. See, every time before earnings, some companies just rise.
That is the most consistent volatility I've seen since Decker 3 years ago.
I mean, it's beautiful. Green to red, green to red, green to red. All of these right before the earnings. Green to red, green to red, green to red. Some of the volatility patterns, if you have it on a 1-year chart, you might not have enough data because volatility in the last quarter of last year was so crazy it threw the cycles off a little bit. Go back and look at 2 years when you're building your expectation. I think it's a good tip if you're going to learn straddles. And by the way, we're going to be talking more about straddles and volatility and all kinds of stuff as we go through earnings season. Matt, fantastic job today. The only thing off about you today is that hat. Is the combine like coming up or something? I saw something, or did they do it? I don't even know.
Not even a football.
I'm not even a good football fan anymore. I got who's a free has the who's the Dolphins free agent pickups?
None
yet.
No, they're trying to go 0-16 this year.
Well, I'll tell you what my Bears did. We traded an all-pro running back that has had more yards than most in the league in the last 3 or 4 years for basically a ham sandwich. So I don't know what we're doing there.
That. Jordan Howard. I mean, I'm pretty sure you can find a Jordan Howard out there.
That's what they believe. But when did it become to where running backs are worth nothing?
When you started picking up people off the street and running 4.8 yards a carry,
don't make me rant. All right, guys.
I would not spend money on a running back if I was an NFL team.
If you guys want a copy of that IV rank, and we'll get the code all built in, we'll maybe even build some stuff for you to help you know how to put it in there. Just send an email to team@Tackle Trading, and we will see you back here tomorrow on the halftime report.
Halftime.
Yep.